This is calm thinking for people who feel stuck in the system. This is quiet million. Liquid isn't the same as free. I went to withdraw cash from my bank. Not a wire, not a transfer, cash from a bank. They asked me to schedule it 2 days out. They needed time to have it ready. I stood there looking at the teller with one thought. What is that vault even for? Because the money was there. It was mine. I could see the number. I just couldn't have it that day. That's not a bank problem. That's the system telling you something plainly if you're listening. The money is accessible, on their schedule, in their amount, on their terms. Liquid, not free. It turns out the feeling has numbers behind it. The Federal Reserve's own data shows household checking and savings balances sitting at $18.1 trillion. As of the third quarter of 2024, up 47%. From before the pandemic, money market fund assets reached $6.3 trillion by late 2024, roughly double their size in 2019. People are holding more cash than they have in decades. Here's the interesting part. At the same time, the Federal Reserve Bank of New York reports household financial stress approaching levels last seen in 2020. Credit card delinquencies crossed 3% in the second quarter of 2024. Personal savings rates fell to 4.8%, well below the 7.5% average from before the pandemic. More cash, more stress. The contradiction is structural, not psychological. The issue isn't how much liquidity exists, it's who controls it and what it can actually do when you need it most. Let's unpack that because modern liquidity is not the same thing as accessible capital. When you deposit money in a bank, you receive liquidity, the ability to withdraw funds on demand. What you don't receive is ownership control. The bank records your deposit as a liability, then lends against it at 7 to 12% interest. You earn 0.5% to 2%, if anything. That's fractional reserve banking. It works until everyone wants their money at once. In March of 2023, Silicon Valley Bank collapsed in 48 hours. Depositors had liquidity in theory. In practice, $42 billion exited in a single day through digital transfers. Liquidity was only restored after government intervention. Money market funds operate under a similar assumption. They promise stability, $1 per share, maintained through accounting conventions, liquidity backstops, and policy confidence. In September of 2008, the Reserve Primary Fund broke that promise after Lehman Brothers defaulted on its commercial paper. Withdrawals were frozen. A treasury guarantee had to be created just to stop the run. The pattern is consistent. Liquidity depends on confidence. Confidence depends on policy. This isn't a critique. It's just how the system is designed. Your liquidity is someone else's float. Financial institutions are built to profit from money in motion, not money at rest. Banks earn when deposits stay put and loans stay outstanding. Brokerages earn when capital rotates through products. Fintech platforms earn when users move money between features, accounts, and incentives. Idle capital generates almost nothing for them, so the system encourages movement, rebalancing, sweeping, trading, upgrading, optimizing. What that means in practice is that liquidity becomes conditional access. You can move money within approved rails. You can transfer between institutions on approved timelines. You can withdraw until controls appear. What you can't do is quietly exit the system without converting your capital into something else. So what does holding it without handing it over actually look like? There are structures that preserve access without surrendering control. They cost more upfront, they compound differently, and they're rarely taught because they compete directly with velocity-based products. Take whole life insurance. It's usually framed as a death benefit with cash value as a side effect. That framing misses the actual mechanism. A properly structured whole life policy builds guaranteed cash value, and after the early years, you can borrow against that value through policy loans. No credit approval. No usage restrictions. No enforced repayment schedule. Typical policy loan rates run 5 to 8%. Here's the distinction that matters. You're not withdrawing capital. You're borrowing against it. while it keeps compounding underneath you. Say you need $50,000. A bank loan at 9% over 5 years costs you about $12,748 in interest. A policy loan at 5% costs about $6,893, and your cash value keeps compounding the entire time, uninterrupted. The difference isn't just the rate, it's who captures the spread. Whole life is inefficient if you're trying to maximize market returns. It's efficient for private liquidity, internal financing, and control. Then there's silver, physical, divisible, and with no counterparty. Bank accounts rely on banks. Funds rely on custodians. Brokerages rely on clearing systems. Silver relies on none of them. It doesn't yield. It doesn't compound. It fluctuates. What it does is exist independently. No institution can freeze it. No algorithm gates access. No policy decision alters who owns it. The trade-off is real. Storage responsibility, verification friction, conversion delay. But if liquidity actually includes control, silver functions as a quiet reserve, not an investment. So why doesn't anyone teach this? Because retail finance is built to maximize float and velocity, not optionality. Whole life removes capital from the assets advisors get measured on. Silver removes deposits from the banking system entirely. Education follows incentive. Advisors teach what lines up with how they get paid. Emergency funds in banks. Long-term savings in managed portfolios. Liquidity defined as institutional access. That advice optimizes for returns and simplicity, not for your autonomy. And the result is liquidity without leverage, exactly when conditions change and you need it most. So what should liquid actually mean? Quiet liquidity is access to capital without permission, without forced liquidation, and without depending on someone else's policy decision. A few honest starting points. Map out your real liquidity needs, fixed expenses, crisis expenses, opportunity capital. Evaluate whole life as infrastructure, not as an investment. Look at the guarantees, the loan terms, the long-term borrowing efficiency. Hold physical silver proportionally as insurance against system friction, not as speculation. And compare lifetime costs, not annual yields. Liquidity architecture reveals itself over decades, not over a single year. If you're holding cash you're proud of, it's probably sitting somewhere built to keep it moving through someone else's system, not built to leave you in control of it. That's not wrong. It's just half the picture. The other half costs more upfront. It builds slower. It asks you to think for yourself instead of taking the default. But it's real. It's available. And most of it has been sitting in plain sight the whole time. The exits are already in the room. Most people just don't know where to look. If you want to follow this as it develops, you can find it at quietmillion.com. No urgency. Just the next observation when it's ready.